Is Wells Fargo Active Cash still worth it? Here's the honest truth. But before we start, you may see a few ads. Thank you for letting them play, so I can keep bringing you free, actionable advice. Now let's continue. Most people picking a cashback card are asking the wrong question. They want to know which card pays the most. But the right question, the one that institutional financial advisors actually ask, is which card delivers the most predictable, tax-efficient, and structurally sound return on every dollar flowing through your balance sheet. That distinction matters. And when we apply that lens to the Wells Fargo Active Cash card, what we find is genuinely surprising. Not because the card is flashy, but precisely because it isn't. This is the honest truth that most YouTube channels won't tell you, because there's no drama in simplicity. There is, however, real capital efficiency in it. By the end of this video, you're going to understand exactly where the Wells Fargo Active Cash sits within a sophisticated financial architecture, who it genuinely serves at an institutional level, where it quietly underperforms, how it interacts with your credit utilization profile and future borrowing power, and how to deploy it as a strategic cost basis reduction tool rather than just a rewards card. Grab something to write with. What I'm walking you through today is the same analytical framework that fee-only RIA firms use when evaluating financial instruments for high-net-worth client portfolios. The kind of analysis that typically costs several $1,000s to receive. Let's begin with the Wells Fargo Active Cash structural overview, because before we can judge value, we need to understand what we're actually dealing with mechanically. The Active Cash is an unlimited 2% cash rewards card on every purchase, everywhere, with no category restrictions, no rotating enrollment periods, and no annual fee. That structure, flat, unlimited, unrestricted, sounds simple. And it is. But that simplicity is load-bearing. It's doing strategic work that most cardholders never consciously appreciate. Here's what that architecture actually means. When you eliminate category restrictions, you eliminate the cognitive tax of optimizing your spending across multiple buckets. For business owners, executives, and retirees managing complex cash flows, that cognitive overhead has real economic value. Time spent tracking which card earns what at which merchant is time not spent on capital allocation decisions that actually move the needle. The Active Cash removes that friction entirely. Every transaction earns the same rate. Full stop. From an operational efficiency standpoint, that is a feature, not a limitation. The 2% return also has a clean, favorable relationship with the IRS framework. Cashback rewards, per long-standing IRS guidance, are generally treated as a rebate on purchases, not as taxable income, meaning the return compounds quietly without creating an additional tax reporting obligation. For investors and business owners already navigating complex tax structures, this simplicity has genuine institutional appeal. Consult your tax professional to confirm how this applies to your specific situation. Now let's talk about the cost basis reduction mechanism, because this is where the 2% return stops being a marketing number and starts being a financial concept. When you frame cashback not as a reward, but as a reduction in your effective cost of every purchase, the math changes. On $100,000 of annual spend routed through this card, you are generating $2,000 in cash back, effectively reducing your cost basis on that spending by 2% across the board. For an S-Corp or LLC owner who is already deducting business expenses, this means the IRS deductible spend is generating a cash return on top of the deduction. You are being paid to spend money you were already going to spend, with no structural complexity required. That's not trivial. That's a mechanism. And the Active Cash delivers that mechanism with zero annual fee drag, which means your net return on the instrument itself, when you factor in cost of ownership, is the full 2%, not 2% minus an annual fee amortization. Most premium cashback cards charge $95 or more annually, which requires you to spend a minimum threshold before you reach break-even. The Active Cash starts generating net positive return from the very first dollar. For retirees on fixed distributions or business owners managing tight operating margins, that efficiency at the baseline matters. Let's move into the float period and cash flow utility dimension, because this is where even financially sophisticated cardholders leave value unrealized. The Wells Fargo Active Cash, like most major credit cards, offers a billing cycle plus a grace period before payment is due, typically resulting in somewhere between 21 and 55 days of interest-free float on purchases, depending on where in the billing cycle the charge lands. That float period is not a trivial perk. It is a short-duration, zero-cost liquidity instrument. For business owners managing accounts receivable gaps, situations where revenue hasn't landed but expenses are due, this float represents genuine working capital flexibility without drawing on a line of credit, without paying interest, and without complicating your liability structure. When you route operating expenses through the Active Cash during that float window, you are essentially accessing a $0 cost bridge between your payable and receivable cycles. Wealth advisors who work with small and mid-market business owners specifically flag this mechanism as underutilized. Most business owners think of credit cards as payment tools. Strategically, they are temporary liquidity tools with a cashback kicker. Now I want to address the Wells Fargo Active Cash credit profile impact, because this card plays a role in your overall borrowing architecture that goes beyond its own rewards mechanics. Credit utilization, the ratio of your reported balances to your available credit, is one of the most heavily weighted factors in your FICO scoring model. Carrying a zero-fee card with a meaningful credit limit and consistently low utilization is structurally beneficial for your overall credit profile, which has downstream implications for mortgage refinancing rates, business credit lines, and commercial lending terms. For high-income earners and business owners who anticipate needing institutional credit, whether that's a commercial real estate loan, an equipment financing line, or a business acquisition facility, maintaining clean utilization metrics across your revolving credit portfolio is not optional. It is table stakes. A no annual fee card like the Active Cash that you keep at low utilization and use consistently supports that profile without costing you anything to hold. In portfolio terms, it's a low-cost position that provides structural support to more important financial instruments. Here is where I give you the honest institutional assessment, and where Active Cash underperforms, because a thorough analysis demands we name the structural limitations clearly. 2% flat is an excellent return on a no-fee card. It is not, however, the ceiling of what's achievable. If you are a heavy travel spender, or if your spending is heavily concentrated in categories like dining, groceries, or office supply purchases, there are cards that will structurally outperform the Active Cash on those specific expenditure buckets. The Citi Double Cash, for instance, operates on a similar 2% net mechanism, 1% on purchase, 1% on payment, but it connects to the Thank You Points ecosystem, which for sophisticated travelers can deliver significantly higher effective redemption rates through transfer partner liquidity. If your spending patterns and financial goals involve international travel or point transfer optimization, the Active Cash's cash-only redemption structure is a ceiling you'll eventually hit. Similarly, for S-Corp owners or LLC operators with significant advertising, technology, or telecom spend, category bonus business cards can deliver 3 to 5% returns on those specific buckets. Returns that materially outpace the active cash's flat 2% when the category concentration is high enough. The honest institutional answer is that the active cash earns its place in a broader portfolio strategy, but is rarely the only instrument you should hold. This brings us to strategic portfolio positioning, which is where the active cash becomes most powerful, not as a standalone card, but as a component within a multi-instrument credit architecture. The institutional framework here is straightforward. You use category-optimized cards where your spending concentration justifies the complexity, and you use the active cash as the catch-all instrument for everything that falls outside those optimized categories. For example, a business owner might route advertising spend through a card earning 3 to 5% in that category, travel spend through a premium card with transfer partner access, and route all remaining miscellaneous expenses, utilities, professional services, subscriptions, incidentals, through the active cash at a guaranteed 2%. This is the architecture that fee-only advisors actually recommend. Not find the one best card, but rather build a capital-efficient instrument stack where no dollar earns less than 2% and strategic dollars earn significantly more. In that architecture, the active cash isn't a compromise. It's the foundation. It's the floor rate that prevents leakage across the remainder of your spending. And because it carries no annual fee, adding it to your portfolio has no cost of capital drag. That is institutional thinking applied to personal and business credit management. Before we move to the summary, let's briefly cover the Wells Fargo Active Cash Approval Profile, because understanding who this card is actually accessible to matters for setting accurate expectations. Wells Fargo historically positions this card for applicants with good to excellent credit. Generally FICO scores in the mid-600s and above, though stronger profiles will receive higher initial credit limits and more favorable terms. For retirees and executives with established credit histories, approval is typically straightforward. For younger professionals still building their credit profiles, the card remains accessible but may come with a more modest initial limit. One important note: Wells Fargo does apply its own internal application frequency guidelines, and applicants who have opened multiple new accounts in a short window may encounter additional scrutiny. This is consistent with industry-wide risk management practices. If you're building out a multi-card credit architecture, sequencing your applications thoughtfully, spacing them out, and being strategic about which cards you open first protects your approval odds and minimizes hard inquiry impact on your utilization profile. Before we close, let me anchor everything we've covered with the final verdict: an active cash value assessment. Is the Wells Fargo Active Cash still worth it? The institutional answer is yes, conditionally, and with full understanding of what it is and isn't designed to do. It is not an aspirational travel card. It is not a category optimization engine. It is not a premium product with a premium fee structure. What it is, consistently and reliably, is a capital-efficient cost basis reduction tool with zero annual fee drag, a clean float period for cash flow management, and a structural role in maintaining a healthy credit utilization profile. For the right financial profile, and particularly as a component within a broader credit architecture, it earns its place at the table every single time. Before we end, let me summarize the critical information you need to retain from this analysis. First, the Wells Fargo Active Cash's 2% flat return functions as a cost basis reduction mechanism, not merely a reward. and generates approximately $2,000 per $100,000 of annual spend with no tax reporting obligation under current IRS guidance. Always confirm with your tax advisor. Second, the no annual fee structure means net return begins at the first dollar. There is no break-even threshold to calculate, which gives it a structural advantage over fee-based alternatives for lower to moderate spenders. Third, the float period, typically up to 55 days depending on billing cycle timing, functions as a zero-cost liquidity bridge for business owners managing receivable gaps and should be treated as a short-duration working capital tool. Fourth, holding this card at low utilization actively supports your broader credit profile and downstream borrowing capacity. Commercial lending, mortgage refinancing, and business credit lines all benefit from clean revolving utilization metrics. Fifth, the active cash underperforms for heavy category spenders and travel optimizers. Its institutional value is highest as the catch-all component in a multi-card architecture, where it guarantees no spending dollar earns below 2%. Sixth, application sequencing matters. If you're building a credit portfolio, consider where the active cash fits in your application order relative to premium cards to protect approval odds and manage hard inquiry impact. The final recommendation is this. The Wells Fargo Active Cash is a structurally sound, capital-efficient instrument for anyone who values simplicity, predictability, and cost-basis reduction without the operational complexity of category management. It belongs in your portfolio. It probably shouldn't be the only card in your portfolio. But for what it does, within the architecture we've outlined today, it does it exceptionally well. If this analysis delivered value, please subscribe for more free institutional-grade credit strategy and financial analysis that you genuinely will not find anywhere else on YouTube. Hit the thumbs up if this gave you a sharper framework for thinking about your credit architecture. And drop a comment below with your questions or with topics you want covered next. I read them and I build content around what you actually need. Disclaimer: I am not your financial advisor. This content is for educational purposes only. Please consult with qualified professionals before making any financial decisions.